honored to chair this fourth session for today. My name is Dr. Melissa Shanageha. I'm covering for someone that he couldn't come due to flight cancellation today. So we'll try to start on time to finish as soon as possible to give you guys time to ask a few questions. So I will start with Albena Melin. She's head of multilateral engagement, vice presidency for partnership, outreach and communication. She do have MSc in international economics, trade and finance. Please, we are pleased to hear your approach in this session and point of view.
Okay, thank you very much. Is this thing on?
Yeah, just press this one. Yes, please.
I don't know. Okay, thank you very much, everybody. Just to say something that you didn't say, I work for the IFC, the International Finance Corporation, which is the private investment arm of the World Bank Group. I don't have a proper speech in terms of how you make speeches at the UN and long addresses, because we're not used to that, really, to be quite honest. But I wanted to come in with a few ideas of how we work with private investors. I haven't heard the name investors mentioned here today. We talk about private sector, we talk about business, we talk about incentivizing the private sector, but nobody actually put the word investors in their mouth today from what I heard. So IFC is the biggest global institution in the world working with private sector and private investors in developing countries and emerging markets. We're also the biggest development finance institution in the world working with the private sector in emerging markets. So we are something of an organization in the middle between private and public. We do belong to the UN family, but in my experience, not many people who work for the UN actually know that we belong to the UN family. And we are the biggest institution in the UN family working with the private sector and for the private sector. So we are owned, as you know, by governments, our shareholders, the UN member states, 193. We have 188 of those as our shareholders. So slightly smaller amount of countries who are our shareholders. What we have worked with the UN on in the past 4 years is basically to engage with the UN and to try to get private investors into UN discussions. We worked very closely with the World Economic Forum and the International Chamber of Commerce starting in 2014 in order to manage attendance of companies. Small companies, big companies, multinational companies, companies from all over the world. And when I say companies, I mean real private sector. I mean the businesses that most of you talk about here. The other companies we define as the financial sector, which are banks, but then we also have the institutional investors, which we define as pension funds, insurance companies, and so forth and so on. So not only, as Agnes mentioned earlier today, does the private sector think the UN is an entity, I think it goes vice versa. Many people in the UN believe the private sector business is an entity, which is actually not true. There's many, many different entities in the so-called private sector. I think a few important things to mention of how we engage the private sector to work in global development processes with the UN, and also how we have tried to accommodate the language and to translate the different perceptions between the private sector and the UN of each other because of where we sit in the middle. So we understand both policy speak of governments at IFC and the World Bank Group, but we also understand the language of the investors. And we are also very capable in doing financial structuring of projects in emerging markets, which leads me to actually say what the biggest role we believe. And not role, I think we have moved far beyond the role of the private sector in achieving the SDGs, and we have moved towards delivering private sector expertise and knowledge to implement the SDGs, on top of the financing that private investors can deliver to invest and achieve the SDGs. I am sure many of you have heard about the publication Moving from Billions to Trillions, even though it wasn't mentioned here today either. And that publication talks about the most essential thing of how to achieve the SDGs in terms of financing for development, namely, how do we mobilize private investment? Mobilizing additional private investment is key to investing in the SDGs and to achieving them. We believe that concessional money, which to us is the same thing as ODA, official development assistance, should only be used for those countries where private investors are not going to go, and should only be used minimally to de-risk operations of private investors who are willing to go into the really difficult emerging markets and are not going to go there because of the high risk, perceived or real. Which leads me to the other very important point when you talk with private investors about achieving the SDGs or going into the really difficult markets. For private investors, and there's nothing bad about that, everything is about a risk-adjusted rate of return. So they're willing to go into a lot of the emerging markets, into a lot of the difficult countries, but there has to be a return. And the de-risking that perception or actual risk for those private investors is our job at IFC, where we work with many of you. We work with bilateral governments, we work with philanthropic institutions, we work with foundations in order to de-risk that investment for the private investor. Because we still believe that if the private investor doesn't go in there, jobs will not be created, additional tax income will not happen, that flows into government coffers, and so forth and so on. So the private sector is necessary for many things, not just to finance the SDGs. It's also necessary, as I just mentioned, for increased domestic resource mobilization, for job creation, for wealth creation, and so forth and so on. I will finish by giving you 2 examples or 3 examples how IFC actually works in order to attract and de-risk very, very risky markets for private investors. So one of the things is to work through platforms. So we establish a platform where investors co-invest with IFC. IFC always has skin in the game, or part of the investment is also ours from our own account, our own balance sheet. We create platforms whereby institutional investors get access to our diversified portfolio of projects. And let me mention here that the financing and the money is out there. The financing and the money is not the problem. The problem is that many, many countries, most countries actually, who want to implement the SDGs do not have the capacity and the skills to deliver bankable projects to those investors, for them to be able to come in and finance those projects. So what we do is to create a platform. Because we IFC have boots on the ground in over 160 countries, we know the local market conditions very well. We develop those bankable projects, and the investors get access to our diversified portfolio of projects. What does a diversified portfolio mean that you can access through a platform? It simply means that you cannot earmark all your investments and say all of our investments will be done in the DRC or in South Sudan or in Sierra Leone or in Liberia. No, because it's a diversified portfolio of projects, and you need to cross-subsidize, to use the wrong term for the thing I want to say. You have to invest also in countries like Mexico, South Africa, Turkey, in order to be able to invest in other countries as well. This is what we mean by a diversified portfolio of projects, and how you can de-risk by the sheer fact that you have a diversified portfolio and access to a lot of countries where you can invest in. Another way how we help companies invest in the SDGs is, of course, and by the way, each company that co-invests with IFC has to fulfill our performance standards, which are the ESG standards, economic, social, governance standards. We are very, very diligent on that. Our due diligence, sometimes investors say that we tend to be very bureaucratic because of our due diligence at IFC, but we're doing that because we want every investor that collaborates with IFC to fulfill our economic, social, environment, social, and governance standards. That's critical to us, which also means that we educate a lot of investors how to work in emerging markets using principles of ESG, and not just investing without looking at those principles and performance standards. So the other example I wanted to mention is this facilitation of investments that we do, where we maybe do not co-invest, but we provide the risk guarantee. The example I want to mention to you is something that we just signed, is the biggest green bond fund in the emerging world, the Amundi Cornerstone Fund, where IFC provides 325 billion in a first loss guarantee, and investors come in to buy bonds in order to invest in climate change activities in emerging markets. We provide only the first loss guarantee as IFC, but we create that platform, we facilitate that platform between investor and governments. And last but not least, I think our new strategy, and I left quite a pile of those out there, how IFC has aligned our business to the SDGs, how we measure our achievement on the SDGs and that of our clients, and how we are starting now, because a lot of people spoke here in the panel previously about data. We actually collect data and the impact that we achieve through our investors. So I just wanted to give you a few numbers, because also numbers haven't been mentioned today here, but numbers are quite important when we talk about achieving the SDGs. So in the last financial year, in the last calendar year, IFC operations increased access to financial services in emerging markets or developing countries for 62 million microfinance and SME clients. IFC clients also provided $411 billion towards microfinance and SME loans in the developing world. So we think those figures are quite important to measure in order to demonstrate that the private sector itself has incentives to work on the SDGs and to achieve development impact. The private sector does not necessarily need to be incentivized by the public sector, but the public sector should provide the enabling environment, the policy framework, and the regulatory environment for the private sector to come and invest in those countries. Thank you very much.
Albena, thanks for giving us insight on how IFC aligned their strategy toward reaching the 2030 strategy. The next on my list is Philip Moss, and he's the head of the World Economic Forum. We are pleased to have him here in the panel, and we are going to hear his approach. Sorry.
Okay. Well, I'm glad I got a promotion to the head of the World Economic Forum, but I can't take credit for that. I do head up an initiative at the World Economic Forum called the Sustainable Development Investment Partnership. I will let Professor Schwab take over the mantle for the forum. So for those of you that may not be as familiar with the World Economic Forum, we're probably best known for the work we do around a little event in the mountains called Davos, the World Economic Forum annual meeting, where we bring together the world leaders, CEOs, etc., really to try and mobilize public-private cooperation in the interest of improving the state of the world. And in fact, we recognized a couple of years ago as the International Organization for Public-Private Cooperation, and that's really what drives the activities of the World Economic Forum. I'll start very briefly just by providing you with a little bit of context with regards to the work of the forum around the SDGs, because I think it's important to set that context, and then I'll give you a little more information on the work that we're doing, and particularly around blended finance, to try and mobilize the investment needed in order to realize the SDGs. So at the forum, we reorganized a year ago, around 14 different systems focused on some of the key challenges the world face, things like environment, education, gender equality, and what we're trying to do through these systems is to engage both the public and private sector to work on how they can leverage off of each other's strengths to address these issues. As it specifically relates to financing and investing in the SDGs, we have systems today around the environment. We convene a group of CEOs every year in Davos to try and figure out how can we move the needle with regards to the Paris Agreement and other issues related to the environment. We have a group working today on impact investing, looking at how we can mobilize the pools of capital that are available to address sustainable development through direct investments. We have a trade facilitation group, which many people don't think of within the context of the SDGs, but really looking at how trade and regulatory frameworks can be important enablers for investment. And then on the periphery, it's not a system, but we are looking at different types of regulatory issues which are impacting the ability to invest and support the SDGs, things like Basel III and Solvency II, to financial regulations, which the financial institutions are telling us are really impeding their ability to be able to invest in certain countries or to invest up to certain levels in certain areas. So with that said, let me give you a little bit of a context with regards to our work around blended finance. This is work that we started back in 2013, I believe it was, Albena. Really to identify how could we fill the funding gap for the SDGs, recognizing that official development assistance was not going to be sufficient to meet the needs there. So we established this initiative, the Redesigning Development Finance Initiative, with the OECD, and worked on trying to build a common lexicon between the public and private sector, which was a critical issue in terms of these two different sides talking past each other. And I'm sure you've all had conversations of that nature. What we did is we created a toolkit talking about how a common language, how institutions can integrate blended finance into their work. We also benchmarked this. We did some surveys to look at how blended finance was being integrated. And then we launched two initiatives alongside the Financing for Development Conference back in 2015, one of which is called Convergence, which was set up as a digital platform to connect investors to deals, and then the Sustainable Development Investment Partnership, which is a coalition of the willing, shall we say, designed to work on collaborating and finding new solutions to use blended finance to mobilize financing for the SDGs. So when we launched, we had about 20 institutions ranging from governments, multilateral development banks, development finance institutions, and pension funds. We've now expanded that to 41 institutions, including regional institutions in Africa and the ASEAN region. We've set up around 4 different kind of work areas, shall we say. The first and the core of what we do is called the Project Investment Review Group. What we're trying to do is actually mobilize financing for real live transactions. So we've built a pipeline around our PRG work of around 84 projects to date, worth over $40 billion. And what we do is actively try and engage our members around these deals, figure out what are the impediments, and try and find solutions that blended finance can address to ensure that these projects get funded. Alongside I should mention on that front, we will be announcing fairly shortly, hopefully by the end of this month, the first deal that's been facilitated through this process. It's a $120 million deal in East Africa that's been financing through our interventions and through a combination of public and private financing to make sure that was moved forward. Beyond that, we're also looking at more systematic ways of addressing the challenges. So we have a stream of activity around looking at blended finance mechanisms that can systematically provide things like credit enhancements, guarantees, junior equity or junior debt to deals to allow more transactions to happen. We're working very closely with our friends over at the Multilateral Development Banks, most of whom are members of STIP, to help them scale up or replicate or share knowledge around innovative programs like the Elazic transaction in Turkey, where they created a liquidity-enhanced risk insurance product that allowed the product to be financed, the project to be financed by new sources of capital. We're also working very closely on the local currency issue. How do we mobilize more local currency financing to take some of the risks off the table? And so we're in the process right now of replicating a model that's been built up in Nigeria for East Africa, and we're also looking at replicating that in the ASEAN region moving forward. Some of the work that we're doing right now is very regionally based. We've recognized that it's not just, I think, as I heard someone mention, the largest companies in the world that we need to help and facilitate. We're also engaging with local financial institutions to help build up their awareness of blended finance, to build up their awareness of what are some of the vehicles and facilities that are available to help them to finance projects, and also to ensure that at the local level, particularly for governments, that there's an enabling environment there that's receptive to blended finance and this public-private financing approach. So to that end, we are doing some additional work around the enabling environment. We're obviously working with our friends over at the OECD around a set of principles for blended finance, outlining what the framework for the application of public-private financing should be. We've also worked with some of the multilateral development banks around principles for sustainable infrastructure. Coming back to Davos again, for the last couple of years, we facilitated a dialogue between the heads of multilateral development banks and CEOs from the private sector, so there can be a communication about what are some of the concerns, where are some of the areas that we can mobilize more private sector financing to address some of these SDG issues. And then more recently, we've also been working to try and develop frameworks and help support governments to establish investment plans that will support not only the Sustainable Development Goals, but also their commitments under the Paris Agreement. So just to summarize this, there are a few lessons learned that we've taken over the last 2 years or so of operating the SDIP. I think the first is that this is not a sprint. This is a marathon. These are long, slow, tough deals. They're not, it's not a case of a missing gap of financing that needs to come in to close a deal. There's an arduous process that needs to take place and a collaborative process as well. Secondly, one of the things that we're seeing a lot of time and time again, even when we find the financing solution for projects, there are regulatory issues that come into play. The challenge of companies having some visibility in terms of the stability of the regulatory regime moving forward is something that we hear quite a lot. I mentioned the language before. It's still an issue. There still needs to be more work done to bring the public and private sector closer in terms of the way they're discussing different issues. And then finally, I think that there needs to be an ecosystem approach to these challenges. It's not going to be enough for one institution or one group of institutions to work on this. What we're finding is that everyone needs to come on board, and it needs to be a very multidisciplinary and diverse group. So in conclusion, we think, and we would like to reiterate that I think there is a lot of support from both the public and private sector to work together. More work needs to be done. And the one thing I would leave out there, because I do hear a lot of the concerns about this type of financing, is that we shouldn't let the perfection be the enemy of the good. There's a lot of efforts coming from both the public and private sides to mobilize financing for the SDGs. In many cases, it's slowed or it's stalled because we're trying to get it right and ensure there's no infringements. And I would say that it's take back to our capitals that if we really want to mobilize financing for the SDGs, we need to be looking at taking the action and perhaps not emphasizing so much the downside risks. Thank you.
Concluding with this positive note regarding the feedback and the hope that we all try to work together. The next on my list is Barbara Adams. She is chair of the board from Global Policy Forum, based in US. She worked for many years at UN.
Yes.
And please go ahead.
Thank you very much. And thank you for the opportunity to be here today. Perhaps if I'd have spoken a little bit before Albena, I would have mentioned the from billions to trillions. In part of the work at the UN, I was monitoring and engaged around the processes of actually trying to do the costing and the funding gap that so many of the initiatives with regard to the SDGs have addressed. And there was a panel, in fact, before the SDGs actually were officially adopted, where the CEO of Pension Denmark actually declared in UN headquarters that the SDGs should be looked at as a big catalogue of investment opportunities. The questions I would like to raise in this context are to deal with not all resource flows are actually quality resources from the point of view of SDGs. We talk a lot about the volume, we don't talk about the quality. And I think we really need to pay more attention to what is up to SDG grade. And we need to pay more attention to how we actually measure that. If you look at the 2030 agenda itself and SDG 17, the one that addresses partnerships, the target there, 1717, is talking about how you measure it. Now, the indicators that have been adopted are very straightforward for this. It basically says that the results will be measured by, quote, the amount of United States dollars committed to A, public-private partnerships, and B, civil society partnerships. I think that's a pretty clear statement that the measure of success here definitely favors the well-resourced, favors big business. So while we're talking here today about the importance of differentiation, we've got to look at the indicators that have actually been adopted for measuring progress. And there's a lot of emphasis right now, and again, people have talked about that, on the importance of a system-wide approach. And the report itself, the JIU report, paid attention to that as well. Now, we've had an initiative in the UN the first time. There has been a common chapter adopted in all of the executive boards of the funds and programs for people who follow this. And in that common chapter, new, there is also a commitment to enhance multi-stakeholder partnerships and intensify collaboration, etc. And again, the measurement for improving this, quote, as measured by, there are two, and the second one is percentage of share of funding coming from private sector partners. There is definitely, in the way in which this is moving forward in the UN, a preferred partner orientation. Despite all of the conversation about multi-stakeholder, there is definitely an orientation to a preferred partner, and a preferred partner that can bring money to the table. I think there are lots of recognitions of the limitation of that. And the Secretary General's report, again, there's a report. There are a lot of proposals on the table at the moment with regard to reforming the United Nations. But before we even get to looking at partnerships, I'd like to put a prior question. Do we all believe that every approach can benefit from a partnership? SDG 16 is about sustainable peace. I am not in favor of public-private partnerships to do with security, peacekeeping, peace building, military presence, etc., in this regard. So I think that we need to, first of all, identify where partnerships are valuable, but where partnerships fit and where they do not fit. The Secretary General's proposal, reform proposals, with an attempt to look at this, have made this proposal for a pool of partner-ready companies as part of the acknowledged lack of due diligence that the UN has at the moment. It has acknowledged very clearly that the UN hasn't developed this capacity yet. But I think, again, if we put together a pool of partner-ready companies a month ago, I suspect Facebook would have been in there. If we'd have put together a pool of partner-ready companies a few years ago, I suspect Volkswagen would have been in there. The whole concept of readiness is obviously very dynamic. It's obviously influenced by external factors that the UN does not control, cannot control, should not control. And there are some other dilemmas that the UN needs to look at in this regard. So I worked for a part of the UN for a while with regard to women and gender equality. So there would be a partnership with a company that was going to do some training and supporting women's economic, entrepreneurial, economic empowerment. A company that the same company was named, or the same sector was named by Margaret Chan when she was head of the WHO as part of the problem there because it was part of big soda. And the problem from her point of view, very clearly articulated, was it's not just big tobacco, it's big sugar, it's big soda. I came here from England, Friday, a sugar tax. So this whole concept of how we're going to do it, I think, is far more complex and deserves a lot of the differentiation that people have been talking about today. So I want to sort of put the remainder of my remarks very much on, therefore, the importance of the UN having a capacity it doesn't yet have, and that part of what the 2030 agenda is driving, and part of what the Secretary-General reform approach is driven by the 2030 agenda can help to address is this whole question about finding this UN capacity. So far, the emphasis at the UN has been, as we've heard, for those initiatives to encourage, to engage, to nurture, to make the UN more business-friendly. There isn't a serious capacity in the UN for oversight. There isn't a serious capacity for the impartial risk assessment that would need to be taking place. This is something that would need to be added if partnerships are going to become such an absolutely key part of how the UN implements its own programs. Now, in the SDG's proposals, there's an emphasis, if you look at it, on refitting, perhaps, retrofitting, capacities and gateways that already exist for the UN. And certainly there's an enormous amount of pressure from the major funders of the UN, basically OECD members, European and the US and Canada, against any new entities. So it is very clear why the pressure is to use the existing entities. But the existing entities have very strong skills in one direction, but not the skills that are at the moment the gap from the point of view, for example, of oversight or the SDGs. So I think this is something, again, that needs to be part of the conversation about partnerships. We heard about the Global Compact and the fact that it is developing and has got a new governance structure. I think it's a very serious challenge. The Global Compact is not basically, although it might have participation across the board, the whole approach to the compact and the way it styles itself in terms of corporate sustainability is not multi-stakeholder. Lots of civil society groups very active around SDGs are not the main ones that are involved with regard to the multi-stakeholder approach. So I think that we've got a lot of gaps, capacity gaps, as well as the actual financing gap. So I would like to sort of say that instead of keep emphasizing in the partnership conversation that what we need to do is to make the UN business ready, which is really the emphasis of most of what we hear and how to go about it, I think we need to talk about where does the UN fit in to help work with business for business to be SDG ready. And in that context, we need new principles. You don't do a partnership with tax evaders and tax avoiders, or you don't work in partnership with companies that are channels for the illicit financial flows coming out of Africa that are way, way, way more than any ODA flows that go into Africa, for example. We need to start finding a way of measuring externalities that someone had referred to make sure that the externalities, environment and social, are going down, that this is measured in part of the process. We have to look at the opportunity cost when we're talking about this for UN staff in terms of where they're putting their capacity in a whole variety of different ways. We have to look at program distortion in terms of what gets funded. Studies of the World Health Organization and some of the papers that have come out are very, very educational from the point of view of how you get program distortion by what is and what is not funded. So this isn't that this is a problem, it's the broader context within which we need to look at those. I found it interesting that only one person today has actually mentioned the member state universally adopted at the Human Rights Council principles on business and human rights as a framework. We have a framework with regard to look at this, and something that is crucial when we start to talk about it from the UN point of view. What is the role of the UN in this, as opposed to what make good partnerships, is that if it's a serious human rights approach, you have to include redress. That is a differential concept that makes it a human rights approach. And those particular principles are trying to do that as well. And one last comment on risk, because I couldn't agree more. I really appreciated some of the comments about the importance of risk and how risk is assessed and managed. But again, from the UN point of view, if we look at the SDGs, a lot of what is needed to achieve the SDGs is counter-cyclical financing. Private sector funding is pro-cyclical. It needs to be. It will be. Unless we find other ways of getting a longer-term horizon, a lot of what we're talking about with regard to climate change, with what we're talking about with regard to front-end investments and so on, is counter-cyclical resources. And so we need to recognize that the risk assessment that the UN needs to do is a different risk assessment. Susan Malcora, when she was the chef de cabinet to the SG a while back, actually made very clearly the point that she said basically that the UN is operating in the highest risk areas in the world, and its calculations and assessments with regard to risk are very, very different. This isn't going to be achieved. The UN is not going to do what it is there to do if it's looking for win-win solutions where everybody can find something, and the difficult stuff and the complex stuff that is getting more and more difficult just gets left out.
Barbara, for sharing your thoughts and your point of view, especially highlighting the gap that UN should today change or try to fit with the actual context. The next on my list is Phaedon Stamatopoulos. Sorry for bad pronunciation. Director of Argor-Heraeus company. Please go ahead.
Yeah. Hello, everyone. I would like to ask the audience a few questions as I start. And I would like to know who here today is wearing or owning gold? Okay. So let's say 50%. Now, if I were to ask these people that have kindly answered my question, do you know where this gold came from? Okay. And then we do not know how it was extracted, nor what the original price was that was paid for it. So with these 4 questions that maybe we can come back to at the end when we describe the partnership in some more detail, just some short sentences about who I am and what we do. Argor-Heraeus is a leading precious metal refinery in the world with focus on gold and silver. We refine approximately 400 tons of gold per year, 600 tons of silver per year, and some platinum and palladium as well. So gold is sourced throughout the world, throughout the globe, from primary sources such as mines and or recycled material, industrial scrap. And the objective of a refiner is to produce high purity precious metal that can then be used in the manufacture, in the luxury sector, in the jewelry sector, or in the investment sector in the form of gold bars or investment bars and so on. Does anybody know what the price of a kilo of gold is today? Good, good. So we're listening? No. The main question in gold sourcing is where is it from? And this is also one of the other topics we will cover in describing the partnership today. So before we go into the details, I think I'll hand over to Mr. Stucki.
Thank you, Phaedon. Good afternoon, everybody. We are actually having a joint intervention here between Phaedon Stamatopoulos from Argor-Heraeus, the refinery, and myself. I'm here on behalf of UNIDO, a specialized agency of the UN system supporting industrial development. And our objective is to share with you our experience partnering together from the private sector side and the UN side to try to improve the conditions of the artisanal miner that are extracting part of the gold that might be in your rings or necklace or earrings. We will explain later on the detail of our partnership and how the supply chain works. I will just make a few points on UNIDO and how we are partnering with the private sector. Ms. Melin, you described how IFC is a link between the private sector and the UN world. UNIDO, as an industrial development agency, we worked also a lot, not only with large-scale industries, but actually most of our projects are focusing on SMEs and micro-enterprises. And we are also partnering with IFC on some projects where the IFC loan is made available for greenhouse gas emission reductions, for example, and UNIDO comes with private sector, so with companies that are requesting credits to do technology upgrades. So we have a very stringent due diligence process before partnering with the private sector, and this is also maybe adding to the discussion of the previous speaker. And what we would like to do now is to present our partnership and see how it is mutually beneficial. So I will be describing it from the artisanal miner side, and Mr. Stamatopoulos will describe it from the other end of the supply chain, from the refining side.
So in a way, this can be synthesized in a simplistic way, I apologize, but as a problem of two halves. The first half of the problem is, how is the gold extracted? How does it leave the ground? And how does it transform from a few grams in the ore where it is found, extracted process, so that it is in a form which can be traded or sold, still impure from the 24 karat standards that are needed further on, but still impure in the place of its production. So that's the first half of the problem. How is it extracted? The second half, which is perhaps a little bit more subtle and less obvious, is how is it sold, and at what price, and how many intermediaries are needed, or are they needed before this gold can reach the market? And at what price will therefore this gold be purchased? This should never be a question. It should always be the same answer. It should be sold at market price. There should never be a negotiation for this second half of the problem. And it is tragically ironic that most people know the price of gold, but many few people who are involved in its extraction in the artisanal mining sector get the value of it. Now, why focus on artisanal gold in particular? If you do allow me just to throw a few statistics, which will hopefully stick. So, if we, I'm sure many of you have seen the famous cube, which is 20 meters by 20 meters by 20 meters. That is all the gold that has ever been extracted from the beginning of time until today. It's 180,000 tons of gold. And every year we add to this 180,000 tons, we add 3,000 tons approximately of gold per year. And I see everybody's taking notes. That's good. So we add these 3,000 tons. Of these 3,000 tons, around 300 tons are produced by artisanal miners. We estimate between 10–20% of the world's gold production every year is produced by artisanal miners. So these 300 tons of gold are sold to intermediaries who, or which, organizations or individuals or traders, you call it what you like, they give approximately 20% or 30% even less than the market price. Not to bore you with all the calculations, but this is a loss to these producing communities, to these producing artisanal miners of approximately $6 billion a year. $6 billion a year, every single year, because every year we produce 3,000 tons of gold, of which 300 by artisanal miners. This is an enormous sum of money, an enormous value, which is lost to these communities. Focus on artisanal gold is extreme, and it has been increasing because, as we mentioned before, the questions which I asked at the beginning, where does the gold come from and how it has been extracted, are questions that the final users and industry are asking more and more and more. The jewelry maker has customers that are asking these questions, and they are happy to be able to cater for this demand by forcing and encouraging refiners and manufacturers to carry out the proper due diligence all the way down to the source. There is a market for this gold. There is a market for the 300 tons of artisanal gold per year for its entire amount, and this will make an incredible difference by paying the correct market price. Some more? Can go back.
Yes. Thank you, Phaedon. So we heard it from the refinery point of view. They understand that there is a lot of value that is not passed to the actual hard-working artisanal miners. So we are here for sustainable development. So I will argue that artisanal gold mining is a prime example of sustainable development issue. If we look at the SDGs, it's about poverty eradication. We have artisanal miners that are doing that not because they like to mine, it's hard work. They would prefer to do agriculture, but maybe climate change pushed them towards artisanal mining. Of course, there is a lot of dust, plus these artisanal miners are using mercury to extract the gold, so there are health issues. Historically, UNIDO has been involved in artisanal gold mining because of the mercury issue. We have been helping artisanal miners reducing or totally removing mercury from their practices. There is a big gender dimension because the role of women and men in the mining process is very well defined in each community. It has an impact on water quality because of the mercury releases. There is a problem of decent work because there is also forced labor, child labor. It's an industrialization issue because, yes, it's an industrialization process. Responsible consumption. I mean, we are buying the gold. Where is it coming from? And finally, it has also an impact on life on land because of deforestation issues. So I just covered 1, 2, 3, 4, 5, 6, 7, 8, 10 of the SDGs only with one topic. But actually, artisanal and small-scale gold mining is providing a livelihood for 15 million artisanal miners. And including the community that will depend on that, we are talking about 100 million persons. And how is it linked to investment? We just talk about the billions that are not being there for these miners. So actually there is a lot of money available that is lost in the supply chain that is needed for also these miners to be able to invest in mercury-free technologies, and that's what we are trying to do. We are trying to provide them with the capacity and the skills to operate without mercury, to have a formalized status, meaning that they have the rights to operate there, in order to be able to sell their gold directly to an international refiner, cutting through all the middlemen, and then having a better economic profit at the end of the day. Why we have that partnership with Argor? I mean, from their perspective, I think it's very important to have no child labor. They have some standards to meet that are actually OECD standards. And from our perspective, we've been focusing a lot on reducing mercury, but it did not help solve the issue because, as we just discussed, it's very complex. It touches on many sustainable development goals. We cannot just look at environmental aspects. We have to look at all the aspects if we want to have a successful, impactful interventions. And that's why for us it is absolutely essential to have that partnership with Argor, to be able from one end of the supply chain, from the extraction, to be able to help this miner sell their gold to the international market, very close to the international price, so it's an additional profit for them too. And I think it's just an excellent win-win situation for, of course, the miners. They are benefiting, they are the primary beneficiaries, but also from our perspective as a UN entity, we are learning a lot from the expertise that an international refiner can bring to the table. And with this, I will hand it over to Phaedon.
Thank you. So as a final comment on the partnership, as we said, as I mentioned, we see it as a problem of two halves. And in a way, this is also a good picture of the perfect supply chain. The perfect supply chain is one which is as short as possible, cutting out all intermediaries who bring absolutely no added value. Instead, they exacerbate the issues and topics that Jérôme mentioned. So a perfect supply chain is one when the market can source directly from where this gold is produced in a responsible, environmentally, socially and economical way. This is the perfect chain, and the market will then take this gold and transform it into investment bars, jewels or watches, with the consumer perfectly informed on the kind of questions that arise naturally these days in this developing market as to the origin of the gold and how it was extracted. Just as a general comment on gold, it has always exerted a special fascination, and it has this unique ability to be endlessly recycled and conserve value. One of the best examples on this is the fact that around 2,100 years ago, a Roman senator would pay for his senator clothes, his toga, 1 ounce of gold, around $1,300 worth of gold. This value is still relevant today. $1,300 will get you, I guess, an expensive suit or dress, but it still is the equivalent measure. It has retained value throughout all these centuries, throughout all economic upheaval and so on. And it has an extremely high intrinsic value of 40,000 francs per kilo today, which makes it imperative to have as short a supply chain as possible. Thank you.
Thank you for this joint contribution. The last on my list in today's session, it's Carolien. She's founder and CEO of Ccharge based in Netherlands. Please go ahead.
Thank you. I think this is working. So delighted to be here. I'm glad to be here given, thank you, given the urgency for change, but also given that we have a number of speakers and participants in the room that can really make a difference. So thank you for letting me address you for a few minutes. Let me start also with why kind of the SDG framework or this meeting is special, and that's in part because I really believe that the SDG framework itself provides an amazing bridge building tool for all of us, because suddenly we're all speaking the same language, which hasn't been the case, I think, for a long time. Clearly, the 2030 agenda can only be achieved through collaborative action and a pooling of resources. The good news is that there's momentum. And as Barbara alluded to before, there's been a report published that really also articulates it as an economic opportunity, which I think is an incredibly important shift in this discussion. The bad news, it's not happening at the scale that is needed. It's still the agenda of a few, and we all struggle to move from talk to action and from action to collaboration. Our belief kind of at Ccharge is that that's really because none of our systems are wired or fit for purpose. It includes our incentive systems. It includes us as human beings. At the end of the day, we all want to run our own show. So how do you then kind of get to a world where you do it together? But also our technology systems. And there was a question earlier about how many platforms that are really out there. We did an analysis with our team where we soon got to over 200 impact platforms that are out there, many of which have launched since the SDGs were announced. About 40 of them were investment platforms. So really the question becomes, how do you get to scale in a world where there's all these little islands roaming and floating around? Our work at Ccharge is therefore focused on triggering, but also equipping actors to come together and to connect for impact. And with that also recognizing that it's incredibly hard. And I think we just heard a story around how just on gold alone, there's all these complexities with one intervention touching 15 different goals. I don't even want to be thinking about the indicators that are involved. So it's a really complex discussion. And so what we're trying to do with our organization, and which is increasingly happening by many actors, including World Economic Forum, as I think is a major player, is to facilitate the agenda, to facilitate the discussion, to surface the pain points, and to really kind of go to points where we feel we can jointly or individually kind of address those pain points and get unstuck. I was asked here to speak about investors as a critical actor in the agenda. $5 to $7 trillion needed each year to finance the agenda. If you kind of compare that to ODA, which is only a few $100 billion, the difference is quite stark. And there's a few points that I wanted to make, which I think should be showing up on, there we go. Let me see how we can move to the next slide here. Yeah, so I spoke briefly kind of about our own mission, but a few points I wanted to make around the investment agenda. One, it's two sides of the same coin. Seems like a bit of a no-brainer, but only if markets or investors ask corporates to be sustainable, then they will. And conversely, only if corporates have the solutions and investable solutions, I should say, markets will move. Again, seems like a no-brainer, but oftentimes these two discussions are happening in two different arenas, different networks, different convenings. So therefore also very excited to have heard earlier today that UN Global Compact, but also organizations like the World Business Council for Sustainable Development are increasingly also pushing those two sides of that coin. In terms to give you a sense of the size of the investments that we're talking about, and in that I'll be defining SDG investing as a term that really brings together what they call responsible, sustainable, and impact investing. In terms of the size, there's globally 87 trillion assets under management. And about 26% or 23% of that I would classify as SDG investments. What that means is that only at the lightest impact screen, so the negative impact screen, which means that you don't want to be investing in fracking and the like, is only 26% of global assets today. And on the flip side, inside that impact investing, which I'm kind of assuming people in the room have heard about, but is really investment with an intention to make a difference or an intention for positive impact, is a staggering 0% of that. So only about 250 billion. So there's problems at multiple levels. Again, won't go into that too much, but the capital oftentimes doesn't find the solutions. So the supply side struggles, the demand side struggles, intermediation, so the bridges between is really hard, and oftentimes also the infrastructure or the plumbing of the market isn't there. And again, the other speakers have spoken about that. An important part of that, which may be relevant for this room, is that also the connections from global markets to local markets and to a local deal room and local investment opportunities, be it national or subnational, are often really hard to make. So I lived in New York for 10 years, touching kind of the investment opportunities in emerging markets on the ground and being able to invest there appropriately is often a struggle. So that's kind of the general sense of kind of what's going on out there in the market. What I really wanted to talk about today is a national agenda which we developed in the Netherlands, where our team facilitated, I would say, I think, as far as I know, a global first national roadmap for SDG investing, together with banks, pension funds, and insurance companies. We came together and ended up calling for collaborative action on the Dutch government, so our cabinet and our central bank. Together, to give you a sense of the size here, these players represent about 2.8 trillion in assets under management. The agenda was led by the sector, so importantly, the actors got together, obviously around 17 SDGs. There was one agenda, 4 working groups, 16 recommendations, and 21 signatories. The reality, though, kind of if you think about how that process worked, is that it was an ongoing dialogue between the financial sector, the central bank, and the government to really think about where the system was getting stuck. It started with literally what is already happening today and what bridges or connections could be between. The 4 working groups are listed on the screen. Blending, the topic that Philip was talking about as well, mobilizing retail capital, so really kind of on the ground, small investors like I'm assuming you and definitely me. So what can I do with my money? So making sure that there are products for any investor, small and large, to invest with impact. Data, we've spoken about that already, and then regulatory change. Key ingredients to the agenda, trust building. There was a lot of kind of building a community, making sure that people would trust each other's incentives and reasons for being at the table. A lot of translation, so people speak different languages. If the government presents a deal, they're not going to be speaking about financial returns, but that's definitely what the sector is going to be thinking about. The sector needs to come to the table and be able to speak about impact, and what does that even look like? Repackaging, so that goes into blending. So how can you kind of take different pools of capital with different tolerance for risk or different return expectations, especially for pension funds, for example. That's incredibly important. They have a fiduciary duty to make sure that the people saving with them have a future capital flow. And then brokerage. So there was a lot of kind of talk about individual deals, who can be brought on board, etc. And what did all of this talking kind of lead to? I would say in any case a concrete roadmap for action that everybody was committed to. So there was a plan, people knew kind of who was working on what, so it gave that clarity. 2, we were able to get people on stage. So the minister was there, it was a high-profile event, the media was there, so it was also an important trigger for people to be celebrating and to be kind of taking it, there was a carrot, if you will, in there. And also, I think after the launch of the agenda, there was also now suddenly for many different actors, which is, you know, also a challenge, but there was also something to hold people accountable for. Just that roadmap alone is definitely not enough, but it was definitely also another commitment by the sector and by the country as a whole that people were for real. And then there were a number of deals that we were able to push through or kind of get unstuck, usually not deals that had not been formulated before, but there was definitely kind of a way to say, actually, now suddenly there's new parties at the table, people coming back to the table. One notable example, which is also listed in the paper, is this investment called Climate Investor 1, where the Dutch government was really hesitant to get on board, and by the end of that process, there was quite a bit of movement in that. So where does that leave you, or me with my invitation for action for you? I guess a few key messages. It is critical to bring the investor community along, and it can be done. And as local actors, you have a role to play. And as the UN, you have a role to play in doing that. The ingredients are there, or some lessons were learned, and I'm very happy to speak with any one of you to kind of think about, you know, what this could look like in your local markets. And as I'm looking at actually I have fellow country representation, so maybe even the representative from the Dutch government can speak to that as well. Following the work we did, we also did a report which you saw briefly on screen with UNDESA as well, where we kind of took this example but other successful examples of where barriers were addressed or opportunities taken on. And again, also that report may give you some tooling that you can bring home to your own ecosystems. And then a number of to-dos that I chose to put on slides that is really kind of, these are bigger bets, these are more important points that we can only address collectively. Take mainstream banking and investment processes as a starting point. These markets are unlikely to move in our direction. We kind of need to meet them where they are. Set up local roadmaps and really be looking at concrete investment opportunities. Third, collaborate to create a global deal room with on-ramps for all investors. This whole global deal room is something that people talk about a lot. Across these 40 platforms, across the different investment opportunities that we jointly have, we need to be thinking about how to make it easy and worthwhile for investors to get on board. Innovate to unlock pain points across the investment value chain. Experimental money is needed. And although I know that the UN system is constrained, also looking at the assets, the data assets, the on-the-ground expertise that you have, I do, and with me many others, I would think, see you as a critical innovation partner in that. And finally, be smarter with the resources and tools and systems that exist already. A lot of this, one of the things, I mentioned the 200 platforms that I mentioned earlier. There's so many different tools and resources and money out there. It's really about that connecting of the dots. That let's think about kind of a repooling or bringing together and pulling up those resources together. And I'm sure we'll get to a success on the 2030 agenda in, I wouldn't say no time, but hopefully soon. Thank you.
Thanks, Carolien, for sharing with us the Dutch experience. Now the floor is open for question. If you want to ask any question to the... Yes, please go ahead. Okay. Yeah.
Okay, so thank you for all the presenters. I found actually really very interesting points there. However, in the end, despite the closing comment from Carolien, I feel a bit pessimistic about that we are going to achieve the goals by 2030. So I'm not really sure if the presenters there actually share me this feeling. And if so, when do they think we can achieve the goals? And what can we do now to accelerate the process for achieving the goals by 2030?
And there I was thinking I was leaving a positive note. So this is me and my positive mindset. I would say I think it's trying to reinvent ourselves. I mean, it sounds really cheesy, but it's kind of like looking at what you have. I know the UN system is incredibly complex, but looking at what you have and what you can bring to the table, and be trusting, I guess, of the other actors that are there. So it's really about the human system, I guess, in that way, but there's not enough. We need to challenge ourselves to act bigger and better, I guess, and I think that goes for each of us wherever we sit.
Yeah, just a small comment, sir. I think I'm not pessimistic. I'm realistic, I think. I would tend to agree with you that we will not achieve the goals by 2030. I would like to believe that the goals are something which should continue forever and ever, because I think it's a transformative systemic change that is needed. I think all of us work in our silos. We all work, like Carolien said in the beginning, you know, this is what we do, and we try to tackle the symptoms of what is actually out there. We're not tackling the root causes and the systemic constraints. Once we start thinking about the systemic constraints, I think is when the mind shift is going to happen. But we don't tackle them yet. Governments don't, private sector doesn't. Barbara is 100% right with the counter-cyclical financing. But who does counter-cyclical financing? IFC is a drop in the ocean. We did counter-cyclical financing in 2008. We financed global trade flows because we saw that with the financial crisis and the decline in global GDP, trade is actually the biggest contributor to world growth. And we financed counter-cyclical trade flows. But you know, IFC is a drop in the ocean. We're tiny. We need many, many more systemic changes, and not to think about the symptoms, but about the root causes.
Go ahead, Barbara. Sorry.
At the level of the SDGs and being ambitious, because for me, the thing about the 2030 agenda that makes it different if we work on it is we've got to be serious about its ambition and its aspiration for transformation. We're all experts in reality, right? And we come up with some very, very good approaches to make things better. So a couple of things on that wish list that's a bit crazy, okay? So first one, and I'm picking up on the counter-cyclical, we need a global tax authority. We really need to stop the tax competition. Countries need to retain their wealth. And in that particular context, democratic governance and being able to engage about having clean water, access to sanitation, which is closer to where you live, and which is part of the whole approach, I think we'd see a lot more progress than we do at the moment, which seems to funnel everything up and then sort of funnel things down, and basically most things get lost or detoured in the process. So I think that to me would be, if we were looking for just one thing, that would be the direction I would go in. The other thing is that I think we really, I know this leave no one behind has become a real slogan, and frankly, I didn't like it during the negotiations, and I still don't, because I also feel we should leave no policies behind. We should leave no agencies behind. We have a situation where by doing it the way we're doing it, you can sign a bilateral investment agreement, which means that a country like Uruguay, if it had gone ahead on tobacco, could not possibly have achieved the SDG on health, because it had been foreclosed by another agreement. We have these issues, it's the systemic questions that have been raised. I think that they're really crucial for getting, and then if we started to do some of this, we'd actually see progress more quickly, I believe. Because once we've got policy space to do different policies, a lot of us know what to do, and a lot of us have been organizing and working together for a long, long time. One other thing I would say on the funding question is we're not going to get the kind of core resources that the UN needs if the UN is doing what we want it to do, because it too has been captured by some of all of this, right? I mean, we all are. I mean, we're real. We're working in the real world. But there is a 2030 fund. We need to move to more pooled resources. And if we're going to do partnerships, it seems to me there's an entry fee. And anything, instead of continuing to earmark, and this isn't only private, it's also public, Before you can do any earmarking, you've got to contribute to the pooled fund. You can call it the 2030 fund, you can whatever. You've got to contribute to the pooled fund, and you will never be able to contribute more, say 50-50, that you can never actually get to where we are today, which is that the vast majority of resources that go to the UN across the board are over 3/4 non-core, and of that figure, 91% is single donor, single project, including the Dutch. The UN has become a pay-to-play and is being used by donors to pick and choose programs. If we don't change that, so work on those ones.
Sudan. Yes, please, the floor is yours.
Thank you. My question is the gold side, about the artisan mining. Can I add, please, to the one of the agenda I've mentioned, another one. In my country, in Sudan, we call it traditional mining, not artisan mining. And 3 problems appeared: environmental problems, soils completely degraded. Secondly, health aspects. Most of the traditional workers, they got cancers because they use mercury and cyanide in producing mercury. Number of deaths increased, mortality increased among young generation. And then third point, important one, is education. Most of the young generation, they depart to the schools and universities, study, and they go to the mining areas to earn money. So I think the literacy will increase in the coming years. So how can we stop this traditional mining in our countries with all this too much work? Because they are poor and they need money in fast way of work. Thank you.
So, thank you for highlighting this. I will try and answer 1/2 of the problem, because once again, I go back to what I said before, that I see this as a problem of 2 halves. So, assuming that once the gold has been extracted, and I won't go into the details right yet of how it has been extracted, but whoever has extracted this gold today and has already gone through incredible hardships to extract it, today has the choice of selling it to a local trader or a local buyer. This local buyer will not guarantee that he will buy all of it, because maybe he's already gone to the neighboring mine and he's already purchased his quota. So the first implication, the first consequence is that this person is going to get less than the fair price of gold. So solving this problem is the second half of the equation, in which the refiner would work directly with the source of gold and pay immediately the market price. So that would be whatever the market price of gold is minus the refining. And just to give you a comparison, if from 1 kilo of gold today that person would be earning 70% of the gold price, so 28,000 francs, from working with an accredited proper refiner, they would earn 40,000, simply from eliminating the middleman. Furthermore, the middleman is often the person who brings in the mercury and the chemicals and sells them at an extra profit. Furthermore, it is usually the person who also brings drugs in order to make people work for longer and harder. So guaranteeing the purchase of any quantity of gold produced by the source and paying a fair price is a way to alleviate the economical problem.
Yes, and I will just add quickly that you're right. It's in many countries it's a traditional activity, so there is no use trying to ban or it won't work. People will just move to another place and start doing it again. So there are some international framework that are more and more constraining the use of mercury. There is now a convention calling the Minamata Convention that bans aims at reducing and where feasible eliminate mercury use. So that will help the health part. There is also the OECD due diligence guidance that requires international gold refiners to source their gold without any child labor. And the enforcement of this due diligence that will be now supported by a coming EU regulation will mean that it will be more and more difficult for these traditional artisanal miners to sell their gold if they are not respecting these criteria. So in short, there would not be any more markets to sell their gold, so they will have to comply to these requirements, which has also an economic benefit, because as we just heard, if we are decreasing this middleman with a more formalized supply chain, it will mean additional economic benefit for the artisanal miners. And lastly, the enforcement of this OECD due diligence guidance means that the different international buyers have to ensure the origin of their gold, which has a link to traceability. So there will be more and more tracing technologies that will be used, which means also that international refiners can decide where they want to source. So if they see that your community is extracting gold in a proper way, you will be able to sell it to the international market. If not, you will be slowly being without any way to sell your gold. So that's how we are hoping that we can help these traditional communities also not to stop their activity, but to do it in a way that is not unhealthy and not damaging the environment. Thank you.
Yes, please, Colombia delegate. No? Okay. The microphone. It's okay now? Yeah. Thank you. I have a question regarding the same topic. I'm one of in my region of origin. I'm here as an independent. I don't represent the government or something. As a citizen, we have see like the worrying of the people, the normal people that lives in towns. Yeah. In a region called Cajamarca, Tolima, the people ask for the government to do a consultance to ask for the people's permission for the gold exploitation in one part that is forest, in which you could find water in natural form and yeah, as clear as you could imagine. Yeah. The worrying of people is that perhaps by leading the exploitation of gold, we will have contamination of the environment. It's an infused idea, an infused concept that it will happen, or by your technical point of view, it's possible to exploit the gold without affecting the sources of water?
I think it's very difficult to start from scratch in a relatively undeveloped area and not affect the environment, biodiversity, water quality at all. I think that's impossible. Any mining activity, whether it's small scale or large scale, has impact. It is possible to mitigate the extent of the damage done, and one of them is the responsible use of mercury or cyanide. I mean, There's only 3 ways to extract gold. One of them is chemical-free, when the geology and the concentration of gold is charitable and you're fortunate to find it. There's mercury and there's cyanide. There's no other way. If done so responsibly, you can really minimize environmental impact. But if you start from nothing on a completely unspoiled area, you will have impact. It's impossible not to. And this process will be catalyzed if it is the only source of livelihood that these communities would have.
Netherlands delegate, sorry.
Yeah, not really delegate. My name is Willem Overbos. I'm from Dutch Network Group, but it is from the Netherlands, so thank you. I've got a question for Carolien. She was talking about 2.4 billion in representation of the companies that you've done the roadmap for. Sorry? I don't understand. Trillion, even more, even better. So 2.3 trillion in funding of the companies that you've done the roadmap with. Is there any plan of using that huge number in investing in SDG initiatives in Netherlands or in the world to get those companies in and well, basically do pitches and invest?
Yes, so this is the total amount that they have under management. So it's also not necessarily their money, right? It's the money that they're managing. And with that, they have made commitments to be reallocating that or shifting that towards impact. And that's kind of that frame that I showed earlier. I'm blanking, to be completely honest, on the exact amount that they have committed. That does go into the billions. The other thing also that has been a global movement is that, especially around the environmental agenda, different investors, so global investors, have begun to make commitments, and that's really where it starts, because then you can begin to hold organizations accountable, you can begin to think about what needs to change inside. So a positive movement, but still a lot to do in increasing the level of commitment, but then also increasing the level of accountability and making sure that the money, and Barbara was alluding to that earlier, kind of that SDG grade is actually protected well, because there is a lot of, there is a risk that it's all going to be bloated without there actually being impact.
Yes, please. IMO. Please go ahead. IMO delegate here.
I would like to thank all the speakers for the inputs. And I would like to, I know there isn't, we are off the time, so I'll address my question to Mr. Stucki of UNIDO. During your presentation, you have mentioned you had some project with the IFC funding. Could you very briefly explain what was your role and what was the IFC's role, and how, in terms of how the money flow and how the project went? Thank you.
Thank you for the question. This is not related to gold. It's related to projects we have on industrial zones where we are helping Vietnam to shift from industrial zone to eco-industrial park. And IFC has similar projects in Vietnam. So we worked jointly with them, but not with IFC financing running through UNIDO. So it's parallel initiatives. We have complementary interventions. And we also developed together an international framework on eco-industrial parks. So that's what I'm referring to. Specifically for Vietnam, we have other credit lines that are made available not only from IFC but from other entities, and in that context we are helping SMEs to prepare the bankable projects to apply for these credit opportunities.
Thanks for answer. I think we are running out of time, and So I have to move to the next session, which is in 5 minutes. Yeah?
Okay, sorry.
Thank you.
So please remember, if we all help and do a little bit, it will make a big difference.